Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that don't make much sense. Now, if you're wondering what all that noise is, it just so happens that I am getting a new roof installed. I don't own the office, but it is getting a new roof, and there is absolutely no time today that I could have recorded this that would probably be any better. So hopefully you can still hear me okay. But it's Hedge Fund Manager Monday, where we're kind of getting back into the normal swing of things, where we look at how the hedge funds managers were positioned from last week. Again, the data we're looking at was as good as of Tuesday. And as I promised on Friday, I want to spend a little more time in the charts looking at some other things other than just bonds. So with that, and again, hopefully you can bear with me through the noise. Maybe it's only really bad for me, although I imagine it is equally irritating for you. But the show must go on. So as we look to hedgeopia.com and their peek into the future through the futures as of last Tuesday, hedge fund managers backed off their 10-year treasury short positions, but they still have a fairly strong short position here in 10-year treasuries, but their bigger position happens to be in the 30-year bonds. So they're very, very short on 30-year bonds, betting on a huge increase in demand in housing. Because where do who gets 30-year bonds? Where do they back? They're going to back 30-year mortgages. So in speculators, hedge fund managers are betting on a huge surge in home buying. Seems unlikely when we look at the last payroll report, where we see that hours worked are overall across the broad economy going down. So it's usually when paychecks shrink or grow slower, and people aren't inclined to move on up. Plus, we've seen these slightly higher interest rates and for 30-year mortgages are not leading to an increase in mortgage demand. We are seeing a downward trending demand curve. So let's take a look at the corresponding positions for that as we look at 30-year treasuries. Today, yields jumped over their 50-day moving average and overnight trading and stayed there for the entire day. And so they're in this long consolidation pattern that, again, if we go and look at symbol TLT, the proxy for the long bond, the most liquid and most tradable treasury ETF, you see here with TLT, I shouldn't say most liquid, that would probably be SHY, the short term, but extremely, extremely liquid, because there's always buyers for treasury securities. You can see it just sitting right under its 50-day moving average. But if we looked at on Friday, it is now sitting right above my poorly drawn hypotenuse of my right triangle here that suggests that a breakout is coming due to the fact there are so many short positions here that are bet on higher treasury yields. Now, when you go back and look at this positioning, and what you see in the commitment traders report is that people are already extremely short the bond market. They've put all the effort into driving interest rates up. There is a point where people either have run out of money to further short or have gotten it to go as far as they believe it can. And now at this point, hedge funds are just hoping there's some data that comes out in their favor, but so far there isn't. And at some point, the market will move in the opposite direction and they will get flushed out of those positions, causing bond prices to rise. So let's take a look at crude oil, West Texas Intermediate futures, near all-time record high. So the market is heavily betting on higher oil prices, just like what happened prior to the last recession, when mysteriously oil prices shot up, not from economic data, but due to other forces. Now, if we go to look at the charts on that, and whoops, where's my little, there we go. We can go down to crude oil, and we can see that today it closed just over 58 a barrel after touching 57, and that's down quite a bit from its recent high of 65. So it ramped up and has gone down. So what we're seeing is extreme positioning in crude oil, and what we look at to validate if this position is correct, if these people that are these hedge fund managers are right, is what is going on in the crude oil space. Are we seeing more draws than inventory builds? No, we're seeing more builds than draws, which is exception the last 2 weeks of the year. It's just not unusual considering there's some accounting things that oil companies do to get crude oil off the books. But what we have seen is product builds in gasoline and distillates, which show there isn't a whole lot of demand. And as a result, if we look at symbol XOP, which is the small oil and gas producers, you can see that they were trying to break out and ran into this zone of resistance and are now facing a revisit of their all-time lows. You notice there are buyers. People are trying to buy this every time it's going down, but the trend is lower. And tomorrow afternoon, we get the API data, and then Wednesday morning, we get the official government data. So let's go back to the hedge fund chart. We can see they're taking more long positions on the S&P. We'll come back to gold in a second. They're still slightly long on the NASDAQ, and then fairly long on small caps. So very bullish on the U.S. economy. Russell 2000 has a much greater exposure to the U.S. economy than the S&P 500. Let's go look at gold. So we're at the largest or second longest, and only difference being last week, speculative long position, meaning the smart money and commercial traders are short gold. So they are happy to sell gold at this price. They think price is more likely to go down, so they want to lock in their price today. But you can see this heavy speculative move in the past has led to a major downward move in gold prices. So let's go take a look at gold mining stocks, which did not make a major move. They did have this move here, but it wasn't like the blowout in 2016 where it went off the charts. It did rise here, but look, it's ran into resistance, and it's got an open gap, and an open gap. And since these gaps, as you can see, generally get filled, it's telling us that due to this speculative positioning, we're not seeing any further increase in price, meaning this is likely to go down and flush out those speculative positions. It is, in my opinion, that the next move in gold will be the big one. Because at this point, all the speculators have effectively transferred their positions to the smart money, and then at that point, there's very little supply. So it takes time for this to happen. We see that the same thing as in the bond market right now. We saw that initial move up, a long consolidation pattern occurring. Why? Because the smart money wants to just get the last of the bonds it can get, and then once there's none and there's a need for bonds, boom, prices are going to rise. And you say, well, why would there be a need for bonds? Well, that is a good question. Let's go take a look at this report that came out from Zero Hedge over the weekend that shows that the aggregate U.S. equity future positions are extremely long compared to history, meaning people are speculatively betting on higher stock prices. If you look at equity flows, people are betting on higher stock prices. If you look at computer-controlled programs such as volatility controls, CTAs, risk parity, quants, algos, these are all trading near the top of their range in terms of how much stock exposure they're going to hold. So these things are very long stocks. You'll notice what I'm not saying is, hey, look at these own a lot of bonds. You're following just the opposite. So here you see vol control, near extreme positioning for them. And when you get everybody on one side, the opposite usually happens. So here you see risk parity funds are very overweight stocks compared to normal. And CTAs, which are trend following computer algorithms, are very heavy in stocks as well. And the net result is you have this divergence between the ISM, the manufacturing sector, which is going down, and you have investors saying, no, stock prices are going higher. So investors are telling the broad market that something is, or the economy is wrong. They're saying, hey, this downturn in the factory sector is not real. The stock market is right, and we're going to get in front of it. Of course, the risk is what happens when turns out the factory data is indeed correct, and risk prices or stock prices need to come down. So even mutual fund managers are loading up on stocks. Everybody is pretty much loading up on stocks to the point where you can see the aggregated U.S. equity future position way up here versus where the factory sector is going. So it does tell us that people are mispositioned, betting on something they perhaps either don't understand which is how the factory sector in the United States does correlate to the stock market, stock prices eventually, or they believe the Fed can rescue the day. So in terms of dollar index futures, hedge funds, looks like they've been flat the last several weeks. Let's take a look at how the dollar is trading. And where's dollar? DXY. So we can see the dollar has been it's sold off a little bit, but it's holding. Now, when you're in a period of a dollar shortage or a liquidity crisis, the natural direction for the dollar should be to rise because there's a large demand for dollars and there's fewer dollars. And that should bring gold prices down. So that is kind of something to consider when you look at those long gold position. And the last you have is volatility. So the hedge fund managers have been backing off their volatility positions their short positions a bit to increase their stock positions as they look for higher stock prices. Let's take a look at some other things. What was it I wanted to look at? We looked at oil, gold, bonds, or something. I mean, you can't really look at stock prices because what you're seeing is multiple expansion. This is where people are willingly overpaying for stocks because they think they're going higher. There's no justification of why they're going higher. The notion is that someone else will be dumb enough to pay a higher price. That's called multiple expansion. We're not seeing earnings validate any of this. One thing I wanted to look at was oil companies. We looked at briefly at crude oil. And when crude oil gets down to this 55 to 54 barrel range, the Permian is not making money. So the fact that oil prices are coming back down would suggest that layoffs are about to return to the oil patch. Now, if we look at, say, Chevron, and want to do just a bit of light technical analysis, you can see somewhere around this $115 price level has been support. So there's been buyers, say, between 110 to 115 very consistently, even down here as low as 100 back in December of 2018. What that suggests, though, is you start getting prices back down 115 and buyers turn into sellers. And when you have a very long speculative position in the futures market, it tells you that stock prices can go down quite a bit really fast. And ExxonMobil is a poster child of probably technical analysis, because you look at this huge topping pattern in Exxon suggesting that when Exxon gets down to 66 or breaks through 65, that all these people that have been buying hoping oil prices are going to go up, because Exxon is in so many different ETFs, maybe one of the most broadly owned stocks in the market. When it breaks its support level where people have been buying, you're going to watch buyers quickly turn into sellers. Oil prices will fall, oil stock prices will fall, and this should bring the entire U.S. stock market down with it, which has mostly been boosted based by tech stocks, as people believe that once again we're in the late 90s and the tech stocks can only go higher. Of course, if we remember what happened to tech stocks following the dot-com bubble, they dropped about 80%. So it is something worth noting. Let's see how we're doing on time. Got a couple more minutes left, so let's see. I do like the scenario in bonds. Again, we've got all this short interest in here, second largest short position in the Treasury bond market. And what kind of data are we looking at coming forward? Well, think about this. You've got the crude oil data. So as there is builds in crude or gas or distillates or even better, all of the above, it tells you the economy is not growing. It's not because they're producing so much. And ideally, a producer wants to produce enough to meet demand to keep prices elevated. So we have too much demand there. You have continuous unemployment claims that are rising, meaning people are going on unemployment and staying on there longer. We have the mortgage data, which is telling us demand for new homes or new mortgages and refinances are declining. That is not telling us that anything good in the real estate market is happening. And then, as we saw Friday, which we've probably come back to and look at again this Friday, is we're starting to see debt defaults in the commercial lending area, and that is dangerous. We only usually see debt defaults toward the bottom of stock markets, not near the top. So when you start hearing things like automobile loan delinquencies at record highs or at the highest level since the great financial crisis, and you start seeing corporate lending start to fall and contract due to defaults, it just doesn't say that what's going on in the tech world is matching the real world. And all that tells you is at some point, all these speculative positions get unwound, and there's really big opportunities for those who own bonds to make money and then buy back into risk assets when they're a lot cheaper. So we'll go ahead and wrap up given all the noise. So I'm Steve Van Metre. Appreciate you taking the time to watch. We'll be back Wednesday with hopefully a new roof, or maybe at least it'll be a little quieter that day. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, our own personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.